I alluded to at the top, the arc of today will take you through some best-in-class current applications, then through the future of innovation and regulation, the ethical banking, and the future tech. So this is our best-in-class panel discussion. Your chair on the end is Nick Sturge from Engine Shed. Recently, the host of Set Squared Bristol recently voted or anointed the world's best university incubator, and a core stalwart of innovation, scale-up enterprise support, and technology cool stuff in the region. So I shall hand over now to Nick and your panel.
Okay, thank you, John. Good morning, everybody. So as John says, my name's Nick Sturge. I've been kind of active in the innovation ecosystem for from a kind of a support point of view for 12 years. Prior to that, I co-founded a tech business, or startup, though we didn't call them startups in those days. Grew that, listed on the stock exchange. And I might dig into some of the experience a bit later. But going a bit further back, I did a degree in electronics. I got a first class honours degree, top of the class, but I realised that I actually didn't understand what it was all about, and really it's people that are more interesting than electrons. So for me, business is all about people. So I think probably throughout the whole sessions today, whilst technology is there and critical, it's not going to work without the people. So I'm sure that's going to be prominent. So what I'm going to do is to say a few words about each of the panellists to save them going on for too long about themselves, and then I'll ask them each to do then I've got a few thoughts of my own, then I'll ask them to do their own provocation, then we'll go into questions, so get your questions prepared. So, starting closest to me, Phil Bates is top banana at Oracle in Bristol, single-handedly leading a charge for making Bristol perhaps Oracle's headquarters. We'll see. And a massive promoter of the cluster here. It's always great to talk to Phil until he starts going on a bit too much about the technology, and I glaze over. But I'm sure you've got more of an appetite for that than me. Megan is Chief Platform Officer at Starling Bank, and previously was Global Product Director at Xero, who we've heard about, which itself was a disruptor in financial management for SMEs. Starling Bank has a mobile-only current account and small business account just coming.
Coming next year.
But it and last month launched Fitbit Pay. It's a quite wide one to pay for your glass of wine on the treadmill. I don't know. I'm sure we'll hear a bit more about that. Who have we got next? Derek, co-founder of Fundsurfer, an early player in the crowdfunding market, also a developer at Drupal Bureau, and a long-time developer in a number of different languages, including Japanese, I understand.
A bit rusty now, but yeah.
Okay. So the democratization of lending and investing has been a big change, a big disruptor in itself in how we engage, especially from my point of view in supporting companies, that whole equity investment thing. So look forward to hearing what Derek's perspectives on that. James Caig is Head of Strategy at True Digital, an award-winning digital agency in Bristol, with an impressive client list, PepsiCo, Fuller's, nPower, and many more. So hearing about perhaps the consumer behaviour and engagement with technology should be interesting. We were due to have Matthew Alder from HM Treasury, but he's been called away, so we can't hear from him. So really interesting to hear Wincy talk about the innovation that's happening within RBS. In my previous business, we banked with NatWest, and we had some financial management software that allowed us to do our banking. It did exactly what we wanted. It used a dial-up modem to be nice and secure, but it worked a treat. It allowed us multi-level control. We were a listed business, so we needed kind of to manage our authority levels. It was only 2 years ago that our current bank that we use in the company I run at the moment to be able to achieve that level of functionality. Now that's quite interesting. That partly because we were too small a business. So the point was that we had to conform to, which is a different bank now, the bank's interpretation of what they thought we needed. So it's one of the challenges about innovation in technology that if you're trying to deliver at scale, especially when margins are squeezed, that you have to make assumptions about what a model business or consumer looks like. Now, we heard a lot about kind of learning from customers just then, but I think sometimes there's a conflict of complexity and sophistication of a product with actually being able to deliver safely, reliable, and at scale. So looking about what's happening at the moment, copy of the Financial Times from a couple of weeks ago, UK shuns cryptocurrency groups. Criminals cash in on rise of cryptocurrencies. So, is it safe to disrupt in some of these areas? So, this session is about current technologies, cutting edge deployment. Perhaps in the short to medium term, we're going to look at the blue sky thinking a bit later. So, as my challenge to the panel, is the UK really ready for disruption? And are we capable? Phil.
Interesting. So, is the UK ready for disruption? I think to some extent it's already starting and it's already happening, right? So it's not a question of are we ready for it, it's a question of how will it develop and how will it evolve and how quickly will it evolve in the UK. There are some key factors that certainly we are seeing in both larger banks and in challenging financial institutions, which is being driven by a combination of things. The first of all is a move to cloud computing and a move to high-performance cloud computing, which enables widespread use of technologies which can be very disruptive, such as machine learning, AI, people starting to build services that change the way that banks start interacting with their customers and consumers in a way we've probably not seen since the rise of the internet banks originally, right? So the ability to enable both sort of peer-to-peer relationships, but also to have semi-intelligent or chatbot kind of interactions with customers, to be able to use a huge amount of computer horsepower very, very quickly through public cloud infrastructure. And then also seeing a lot of the existing banks challenged to get to that process, because to move to a world of much, much faster development of the way that we interact with our consumers also requires that we change the culture of how we start developing and delivering applications within companies. And so in many respects, although I will never agree with you that technology is more important, actually I do agree with you, it's more that people are more interesting than technology. The comment that was made in the keynote as well, the culture of banks and how quickly the culture of banks changes to address the need to work in a much more agile way in terms of changing the applications we do believe. I think that will actually be the discriminator between the dinosaurs that don't survive this epoch, as well as the fintechs that are challenging and coming through, that are going to change the way our banks work. So I do think that we're ready for change. I think it's already happening.
Okay.
Yeah,
Megan.
definitely. I would second that. So the UK is absolutely ready for disruption, already seeing that happen. Just to build on of your point, so with cloud hosting, it's only been since November of 2015 that financial services such as banks as Starling can actually use cloud hosting rather than using mainframe databases. But what we've seen from a security point of view is that actually increases security. So if you look at these different systems, they can use things like availability zones. So you can store your data in various locations. The people who have access to that data don't actually know what's stored on that server. You also have elastic scaling. So if there is a DDoS attack or some other type of attack on your systems, it can elastically scale to accommodate that. There's also a number of different, basically, security systems that they can implement that just isn't possible from a mainframe perspective. Similar to open banking, though, the whole point of it is that customers are already sharing their data. They're just forced to do it in an insecure way by screen scraping, so they have to enter in their credentials. And so basically what the government has mandated with APIs is a much more secure way of sharing your data, and it's basically shifting that ownership from the traditional institutions to the customer. Saying the customer owns their own data, they should be able to share it with whatever financial technology company they would like to do so, and it's up to the banks to help them securely do that. But really what we've seen, if you kind of look back, is that banks were pretty good at keeping up with technological change until the financial crisis in 2008. And then basically what happened is you saw all of these new rules and regulations being imposed. You saw fines being imposed for mis-selling and other scandals. And basically innovation just dropped to the bottom of the priority list. But at the same time, it was in 2008 that the iPhone launched. And then WhatsApp and Uber and Airbnb. And so this gap started to emerge between what the banks were offering and what consumers were starting to expect, particularly in terms of user experience. So when we started Starling, our founder, Ann Bowden, comes from a long career in banking. She's one of the dinosaurs. Our exec team is split between dinosaurs and techies, I guess you could say. But the whole point is that we saw this opportunity to bring innovation to banking that you'd only seen from consumer technology companies, but we wanted to do that by building a bank from scratch. So literally building the back end and the front end technology, gaining the banking license and offering those same types of consumer benefits around FSCS protection. But really what we saw is that banks, what they were traditionally doing is they were incentivizing customers to join with some sort of loss-making introductory offer, like cashback on spending or free travel insurance. But the current account was loss-leading, it was the dumb pipes, right? So the way that they monetize is they have to upsell higher profit revenue products like credit cards, mortgages, and loans. And basically, when the CMA came out and did this analysis of what was happening in financial services, they found that banks were making their fees too complex for customers to really understand what they're paying. Even just for spending on your card abroad, there was not only a fee for making a foreign transaction, but then they'd inflate the exchange rate. So it was hard for them to understand the fees they were paying, much less where they could get a better deal. And then they were also not improving the product experience. So they weren't improving price or product experience. So that's why they mandated opening up of the APIs, and they're now enabling entrants like Starling to get banking license to compete on equal footing. So for us, what we do is we not only look at how do we enable you to open up a current account, but we want to operate much more like a tech company. So saying the type of disruption we're seeing is now these banks, these challengers can say, what are customers experiencing in banking? What are their current user journeys? What are their pain points? And how do you solve those in delightful ways? Rather than usually product managers at big banks just talk to you about interest rates. And that's interesting, but what that means is it shifts so that you can solve things like, can you open a current account in less than 2 minutes just off of your mobile phone, rather than having to go into a branch location? For us, we have no fees at all whatsoever. There's no fees for foreign transactions, no fees for ATMs here or abroad or anywhere. But there's types of ways that you can disrupt and innovate, not only from technology, but from the fees and the user experience that the customer has as well. And I think we're seeing that not only in the UK, but throughout Europe as well.
Okay, we'll come back to costing, because I think it's going to be quite an interesting one. Derek?
Yeah, okay. So we're already seeing the banks being disrupted, by crowdfunding platforms years ago, and whether this is equity or debt or reward and donation, these are all becoming quite mature now, and whole industries are growing up around them to help those projects and businesses raise money using these systems. And going to what you said about banks being kind of too complex about lots of different things, all these things have been unbundled. So you have TransferWise, you have for foreign transactions, you have credit cards that you can get from other suppliers. So everything's been unbundled. But I think now what we're seeing, the interesting thing that's happening that's disrupting these things that have already disrupted the banks, is things like Bitcoin, it's things like cryptocurrencies. People are raising money using selling these tokens, these cryptocurrencies through ICOs, and being able to raise a lot of money, completely unregulated, very quickly. And this it's global as well. So the kind of existing platforms, the existing institutions, kind of need to work out how to work with these. There are horror stories about people making a lot of money from Bitcoin, but then maybe if you want to change it back to sterling, the bank might close your account because it looks like a dodgy transaction. So there's lots of things that need to happen to kind of keep trust across these institutions and to make them friendlier and for people to be able to use them.
No, it's interesting because you've got these tensions between trust, margins, sophistication, in an environment where we're learning to trust new technologies, but the pace of change means that we're starting to lose trust. And as banks become ever more, lots of financial institutions become ever more sophisticated, the complexity increases, and can any organisation manage that complexity whilst maintaining that trust relationship with some of the more educated and some of the less educated consumers of their product? Interesting. James?
Yeah, I think there's I wholeheartedly agree with the other panellists that and Wincy, there's an extraordinary amount of change happening. It is the only constant. The pace of change, the rate is what's so kind of exhausting at times, but exciting. All verticals are changing and being disrupted. Products, customer experience, all of that stuff. But there's another narrative that I think it's possible to see within finance and within fintech, and that's that actually very little is changing at all. The adoption curve is by definition a chronological thing, and while those of us in the conferences and the clusters and the coffee shops are adopting this stuff and very excited about this stuff and showing each other our Monzo apps and loving kind of what we're seeing because it's telling a story about ourselves. There's a huge late majority laggards who are not anywhere near that, and I think Wincy talked about being married to the banks and that we're not and we don't leave, we don't divorce, we have affairs. I've been married 13 years, which puts me about. To my wife, this is. Puts me about 2 years ahead of the national average of marriages in the UK. That's how long the average marriage lasts in the UK, 11 years. I'm still about 4 years off with that, the length of time, the average length of time we spend with our bank account in the UK. So we change our spouse more often than we change our bank account. It's a market defined by inertia from consumers as much as it's defined by change that's being wrought by technology. And that's because we are fearful, change is scary, effort and reward need to be in balance, it's complex. When it's that easy to get things wrong, sometimes the smartest thing to do is nothing. And that's what people tend to do. We're not maximisers in life. We're not constantly seeking for the best return on investment. We just want an easy life. We're emotional beings. Now, there is an argument that says, I think, that lots of the technology that's making life easy, that's providing more delightful experiences and making that service easier for people will accelerate change, will make adoption easier and more likely. But there's also a risk, I think, that it will do the opposite. It will exacerbate that fear of change. There's research that we're doing at the moment with a research partner that's looking into people's attitudes to fintech. With not just the early adopters, but the kind of the not rejectors, but there's just the people in the middle, the normal people, and they have great concerns over privacy. They have great concerns over things like people. And when I talk to a real person, and while the core is fantastic, and I think that human element, interaction at a human level is what's going to make the difference. As an idea, conceptually, people want to know there's a person at the other end of that, and that's what branches mean for people. It's establishment, it's heritage, it's people. But there's also providers as well. I think there's a big sense that from people that with regulation happening since 2008, and by the way, people are still not changing banks, even though the decline in trust. With regulation happening now, there's a sense that all banks are just the same. You all have to offer the same stuff. So whether you're Starling or RBS, what am I going to get that's different? More reasons not to kind of change. So I think brands are talking at a product level, trying to get people to switch at a product level, but I think there's a category challenge that people are not considering it.
Fantastic. Thank you, James. So, questions from the audience to our wealth of experience on the panel. Any questions? Otherwise, I'm going to have to ask some questions, which would be terrible. I did tell you to prepare. Didn't I?
Hi, that was really helpful discussion. And what I'm interested to understand is going back to the concept of consumers having affairs with other product providers, whether at some point services become so frictionless and your ability to open a bank account in 20 seconds becomes so easy that actually you fail to create that sense of loyalty as a result of that frictionless process, and that actually the need to spend a bit more time with a more traditional provider makes you more loyal to them because you maybe trust them more. Maybe that's the thing. Do you get the sense generally as product providers, product developers, that frictionless banking or frictionless services might actually be a detriment to the industry?
Okay, thank you. Megan.
So it's interesting. When I worked at Intuit back in the day, I started, and I remember one of the executives was presenting on their desktop product, and they basically said it was so difficult to set up that no one would ever leave afterwards because they didn't want to go through that pain again. So they're incredibly loyal, not because they loved it, it was just so painful they didn't want to go through it again. But similarly, when we were working on moving our desktop product online, we found that in the US, people wanted to set up this financial accounting software the same day that they wanted to like pay their employees. And so we would streamline it down to basically trying to make it as frictionless as possible. And what we found is when we had this 12-page process versus 5-step process, people fell out of the experience just as fast. And what we found is it's either too long or if it's too short, people lose confidence. They'll say, we know that you need to ask certain questions. You didn't ask them, so therefore I don't trust you. Even though it was coming from a very well-known established company in the States that had been operating in the space for 30 years. And so similarly in banking, what we look to do, like with the setup process, is you do have to have that balance. So you still have to enter in the kind of expected pieces of information around like your name and address. You have to take a photo of your passport. You have to take a short video of yourself. But what we found is making these processes that are currently very paper-based, where you have to call in, make an appointment at a branch location, and you have to bring in loads of documents, and you have to fill in loads of forms. When you remove those pain points and just make it really easy to do those same things, that the reaction is very positive. I would say similarly, there's certain things like with switching your current account. So now current account switching, I'm not sure if you're familiar, it's a government initiative where they basically have said, we have a 2% switching rate. So people really do switch spouses more than they switch their bank accounts. But when the Competition Markets Authority did this analysis, what they found is it's not because people just love their bank. It was because it was too hard to switch and they didn't see any incentive to do so. It was all kind of the same bunch of options. None of them were really that much better, and part of it was the whole complex fees thing. So for us, we differentiate in terms of making it really easy to open an account. But then when you want to switch account, you just have to put in your account number and your sort code of your other bank. We move over all of your funds, all of your direct debits. We close your old account. We do everything for you. We make it very simple. What we found is when we take those types of processes where people don't feel they need to spend a lot of time doing it, that doesn't increase their trust, that the reaction is very positive. So I think that, but with any type of new banking experience or financial experience, you do have to ask yourself that question of what's the right amount of friction. One of the things that we're working on now is called our marketplace. So we want to be the world's best current account, but we can't also be the world's best mortgage and insurance and peer-to-peer currency exchange service. We recognize that fintechs are focusing on doing these things very, very well. So we're building out this marketplace where instead we're saying, let us aggregate these services from across the market, help you to securely access them. Instead of filling out loads of forms to access any of them, you can also share your data. But it gets to that question earlier that Quincy was answering around, do people know what it means to share this data? How do you present that to them in a way where they understand you can share it securely by an API, but now this customer will know your PII, your personal identifiable data, as well as all of your transaction data. So for us, it's about, there's two steps. One, the friction is actually with onboarding the partner. So we do a lot of due diligence. We have very granular APIs, so we have to basically make sure that any of these fintechs isn't accessing more data than they need to actually perform the service. But then even so, showing that to the user, saying they will get your email address, which means that they can send you various materials under the context of their privacy policy, which you'll see. But then they'll also receive this data. Here's how you can authorize it. Here's how you can revoke it at any time. So there's other areas of friction that you almost want to introduce friction to make sure that customers understand the decision that they're taking effectively.
So you're actually, go back to Wincy's point about having a fair loyalty and having retaining your marriage and then having affairs. You're creating a brokerage for affairs with other products.
Yeah, exactly.
There's an app for that, isn't there? Derek or James, did you have a comment on that?
I think experience not to the same sort of intensity as you've experienced, Megan, but when we were working with a startup business called Wealthify. They're in Cardiff. They've just been invested in by Aviva. And we worked a lot on the balance between seamlessness and just enough effort to make it seem not too good to be true. It's robo-investing. It's powered by AI in some form. The extent to which people need to know that is kind of debatable, but the interface is where you give a sense of what the brand is, and so that balance between just enough, the trust effort, reward is kind of very difficult to get right and will be very different in different categories. So I think there's how you look at the interface and experience and how you kind of calibrate that correctly for the kind of effort and reward people are getting from it. But I think more broadly, there's the I think one needs to zoom out of that a little bit and say what is the product or the service that is being taken out or bought. We all bring different contexts to those administrative kind of tasks. If I'm and we are emotional creatures, we value the short term over the long term. That's why we find signing up for a pension more difficult than going through a mortgage, because we get a house. We call it buying a house. We're taking out the biggest loan we'll ever take out, but we call it buying a house. So the way I conceive of that emotionally makes that process a little bit easier. I'm prepared to take on a little bit more graft because I'm getting something more emotive from it and something more immediate in the short term too. So I don't think there's any right answer, but it is how all those factors kind of calibrate for the right level of effort and reward in that moment.
So, going back to the technology a little bit here, are there technologies that are in existence, perhaps behind in the toolbox that haven't been deployed yet, that either the market's not ready or too risky, unsafe? What's there lurking in the background? Phil, any thoughts?
I think one of the things that it's a broad actual question to answer. So one of the things that's going to be really important in differentiating who moves fast or not is the degree to which people are able to really get on top of how quickly they can deploy changes, deploy new features, deploy new ways of engaging with groups of consumers, right? A/B test that, see how that works, and continually to roll that out live. So what we're seeing generally, not just in fintech, but across across a whole series of different vertical industries, is that the ability to be able to almost have a fluid delivery of applications. All right, so that it's not like you roll out something and then you just like I've got a banking application that does my current account. It probably hasn't really been changed for 10 years. It's got very, very few features it didn't have in 10 years ago, and it even looks like it did 10 years ago, right? And there's probably most banks probably have their basic current account online software. Doesn't look much different from what it did in the late 90s. I think that there is an ability now that's driven by technology, by cloud computing, but also by technologies that allow developers to write code very quickly, to be able to deploy that through automated testing, to be able to see how consumers are interacting with the new feature versus not having the new feature, and then to be able to roll over to the rest of the consumers to that new feature. I think that the degree to which we see, and I think it will come through challenges and through some of the most innovative development groups within banks, the more that agile delivery of software and technology enables the driver of experimentation and new features and so on in ways that doesn't scare the hell out of people as well, right? There's ways to do that. I think that's what actually will drive change, not any specific underlying technology, whether it's blockchain or AI or whatever it's said. It's actually the methodology which will drive the speed, right, if that makes sense.
Okay. Derek?
Yeah, I think going back to Wincy's talk about APIs, it's what is making these exciting changes possible so quick is that we're reusing these existing services and elements and using them, putting them together in ways that people might not have necessarily expected. So you're using a payment processor, you're using identity authentication and things from Facebook or Google, and so it's probably going to be small niche platforms that are creating something to fit one small immediate need that then will kind of set the tone, I think, and then bigger companies will either copy that or take it all on board in the same way that Facebook buys anything to do with photography or AI or something. So I don't know about new technology, but it's reusing things that currently already exist that you might not have thought about in a way.
But do you think that the deployers are taking enough risk, or are we already pushing the boundaries of risk in terms of damaging trust and loyalty and safety of information?
I think that comes down to regulation, because the technology is there to build, I think, what you want to build. But when you're interacting with people's money, or you're working with banks and other financial institutions, there are things that can't do or it's very slow to do. So I think it has to come from the regulation side.
I think there's two different things on the risk, and of course managing people's money, managing the risk associated with that is important. But I actually think, in general, banks are extremely risk averse in how they interact with consumers. Right? I think there's all kinds of ways that we could interact with customers differently, right? Or to try ways of interacting with customers, dealing with whatever it is, current accounts, mortgages, whatever. If you actually look at the different products on the market, there's very little differentiation, right? And there's different levels of quality service, obviously. But the number of different ways that we could provide access to funds, to provide access to loans, to be able to allow people to pay back in different ways, there's lots of different things that banks could experiment with, right? That I just don't see that much of it in the market. So I think that banks are averse, the finance industry generally has been averse to the ways it interacts with customers, maybe as a result of the culture of protecting of the risk that kind of further back in the system. And I think there's probably wide open opportunity, given the ability to roll out systems much more effectively, to be able to experiment and to do with that. And whoever gets that right is going to make a big impact on the market, because I don't think consumers are generally delighted by their experience with banking, and there's every opportunity to make that happen, right?
I think you're right that I don't think there's a bank that's come up with a Clio, for example, right? And that's that overlay, that use of technology that already exists to make life relatively easy and simple for me. I mean, still the adoption of that. I'm now getting chased by the bot saying, "Come on, you showed interest. Come on, get on with it. Sign up." Which, not more politely than that, obviously. Yeah. I think yes. I think from. I don't, I'm not qualified to talk about the sort of the technologies that underpin this stuff in the same way. But I think taking Mega's point about the kind of the shortfall between where 10 years of the iPhone has got us versus 10 years of banking post the crash, what those services and icons that we use on the screen do is they allow us to feel like experts pretty instantaneously. We can all become brilliant photographers with Instagram. We can all feel like not a tourist by using Airbnb. They kind of do the hard work to help us feel smart and help us feel good at what we do. And pretty much most of the financial tools that people kind of come across do the exact opposite. And all we want to do is feel smart when we're doing this, and we want to feel like we're not getting it wrong. So I think somewhere within what you've been describing and the way to sort of enable that, both organisationally and also technologically that underpins it, is the way to render that in a way that helps me know when to do something, help me know what to do, gives me the feedback loop that I've done the right thing, and helps me get on with the rest of my life, because very few people are thinking about this stuff as much as any of us in this room might be, and that's hard work. So,
thanks, James. Right, more questions at the front. It's down here. Shout.
Yeah. So this is all really interesting to me because I don't know anything about this at all, and in fact I feel like a dog that's come in off the street and found myself in a cat's bar.
That old chestnut.
Yeah. So Monzo and Yolt and Starling, I can hear about the technology, but I still don't understand why I would be interested in this. I mean, what's in it for me? What's the value proposition for me, the punter?
Yeah. So for us, our premise is that banking is essential, but it's currently really very bad. And the banks haven't been innovating. We wanted to bring the innovation you see from tech companies into banking. So everything from setting up the account and making that really easy, to transparency around fees, to insights into your finances. So to the point that he was making, people want to feel confident around their money. They want to make better financial decisions. Not everyone is like us and wants to spend all of their time thinking around how to optimize their financial lives. So to give people tools to make that really easy. And what we see from incumbents is there wasn't just a legacy infrastructure problem. There's also cultural hurdles that you have to overcome to enable disruption internally. So for us, we decided to take a different tact to start a bank from scratch. So there's those appealing things. There's also, from our perspective, what we see is just in terms of improving people's financial lives across the full retail banking set. So right now, in London, in England, and Bristol, and other hubs, what we see is that there's been a proliferation of venture capital pouring into fintech. And these fintechs are trying to solve particular areas and provide better user experience and better price But customers are currently kind of inundated with choice. There's almost too many options, and people don't even know which ones are safe to use and which ones they should use. And if they use it with their bank, they currently have to use a screen scraping method where they have to enter in their credentials, and then the bank tells them that violates the terms and conditions on their account. And the whole it's not very accessible currently. And so about 5 years ago at these types of conferences, everyone was talking about the unbundling of banking and the threat of fintechs. And now everyone feels like it's kind of cooled down to like, oh, they didn't replace us yet. But what you saw is at the end of the day, all of these fintechs were still dependent on banks because the banks are still at the core to like move funds. So it's only now that tech startups like Starling can get a banking license. So which means that you can insure customer deposits up to like 85,000, but you can also do things like directly connecting into payment schemes. And you can also, we have this opportunity from across the entire landscape to integrate in these different fintechs. So it means, so say now you're using Starling. So as you pay on your card, you get an instant notification saying how much you spent. So this is different because at your bank, it's currently 2 to 3 days out of date, right? And then we'll give you an insight saying you just spent £5 on entertainment. You spent 200 this month. But then we can take those insights and ladder it up to an FCA compliant affordability assessment. So say then you need a line of credit, mortgage, or a loan, we can automatically pre-approve you for that. So then instead of filling out loads of documents and going through that whole process again that you've already entered all that data we already have, if you authorize us to do so, we can just share it across for you. So all of a sudden accessing all these other products is much easier. And in this marketplace, we have the opportunity to do what tech companies do, which is to build what's called a network effects platform. So basically in one of these models, the more buyers there are, the more it benefits the sellers. The more sellers there are, the more it benefits the buyers. So the more people who sell in the marketplace, the more competitive it gets. So it usually drives them to not only create better products, but to reduce their prices. So like on a loan comparison site or an insurance comparison site, you typically get the best rates. So similarly, the more buyers there are, the more it benefits the customers. The more customers there are, the more benefits the buyers, because then they can sell more products. So creating this entirely new model that's completely unlike anything you've seen in banking to date to increase the experience across the whole spectrum of products.
But the challenge is people like Matt ready for what sounds like even more complexity? Will the first thing I hear from the mortgage provider a letter through the post or an email that says, we've seen your credit rating, your affordability, you can't have a mortgage, and that's the first I hear. Are these things out of our control now? And so all those things make sense, but it becomes more and more complicated.
I think you, by asking the question, you've kind of demonstrated the kind of challenge I was trying to draw, and I think the research partner that we're working with, in the quant study they've done, I think they've interviewed about 1,000 people, and about 83% of people couldn't see the point of switching. It's just not, the effort and reward is simply out of whack. The truth is, most of us, if we're asked why did we do something, we don't really rationally put everything in a ledger and work out the pros and cons and then decide that's the best thing to do. We have an emotional instinct that we then post-rationalise, and a lot of the times we'll do something because we've seen other people doing it, it becomes normal. And that's why you might have Uber on your phone, and it's probably why you've got Netflix, because it just sort of started to there's a tipping point these things reach. I think there are fantastic options out there, but I think that there isn't sufficient distinctiveness between the offers for people to know what the positive move to that is versus a negative move away from what I experience currently, and you need both at the same time, and there's not enough of the positive why in the market at the moment. I think.
Briefly before we get on the question.
That ties a little bit back to the earlier question about friction, right? So reducing friction, fine, you can onboard people more quickly, but don't do it too much, otherwise we won't trust. But friction itself isn't the issue. It's actually about providing the reward feedback cycles, right? As you mentioned earlier, right? We live on short-term rewards, right? We like to be rewarded for what we do, and sometimes the reward is very simple. You get some gems on a phone, on a Spanish training app, and people do it religiously because they want the gem. Now, with money, it's a little bit better, right? You get cash in your account, right? Or you get a product that's better. But I think that. I think that just as there hasn't been, I don't think the regular banks have really established how to increase people's motivation through short-term rewards of how they're interacting with the services that they got from the bank. And I don't just mean like, I got a reward because I stayed over an overdraft limit or something like that. There are lots of different ways to get people interacting more regularly and in more interesting ways, but you have to experiment to try those things. And experimentation, I think, has been very, very low, right, in terms of how people have interacted with consumers for a while. and that equally opens the opportunity. I think there's lots of fintechs that will use that space, right, to take potentially market. I think it was, sorry, I'll be very quick, I think it was Citigroup last year put out a blog that they reckoned that the number of employees in American banks would drop from 2.6 million to 1.8 million by 2025 because of the challenge by incoming fintechs. And so I do think the very thing that's prevented the growth is the very thing that creates the opportunity as well, if that makes sense. Sorry for a long answer.
Okay. Right, there was a question in the middle somewhere. Yes.
Hi, it's Alex from Hargreaves Lansdowne. In your honest opinion, where do you think we are in the public cloud computing hype cycle? Obviously not a silver bullet. There are trade-offs, like cost. So do you think the pendulum has stopped swinging, as it were?
Do you know about cloud?
No, a bit about cloud, yeah. So I lead Oracle's Cloud Development Centre in Bristol. So we make Oracle's cloud products. And we're certainly not in the trough of despair, or whatever it's called in the Gartner hype cycles. I think where we are actually at the moment is we are past the euphoria of cloud's going to change everything, but we are absolutely into the mainstream of pretty much every Fortune 1000 company in the UK, certainly all the big government departments, etc., are all looking to see how they can move into public cloud computing pretty much as fast as they can. So there are a number of reasons driving that. What cloud computing does fundamentally is it allows businesses to change their digital and IT strategies away from a CapEx model into an OpEx model, right? There's a fundamental change there, so that rather than having big projects, I buy a lot of hardware, I pay for a lot of consulting, I do a lot of on-premise stuff, I have to get very large budgets up front, we move into a regular operating expense model where I'm paying for what I'm using, I can innovate as I do it, and so on. And I think that we are seeing that accelerate now very, very fast through large companies. And I think the economics drive that, but also certainly the maturity of cloud platforms. And obviously, I'll talk to Oracle's. You mentioned before about the security of clouds, for example. We completely redesigned how modern data centers would work to allow things like a fire or a plane crash into one data center, enables workloads to continue working. There's a huge innovations gone through on security. So we're seeing banks, we're seeing government departments, we're seeing defense industries move into public cloud in a way that we wouldn't have seen a few years ago.
So it's real.
It's real, it's very real, and it's very relevant.
Cloud, relationship, obviously, but is it real?
I would
or
just
is it
say
hype?
cloud is just useful because it lets you innovate quickly. You don't have to buy hardware.
Yeah.
You can experiment. I don't know if it has direct, although it sounds similar to cloud, but
Well, it allows you
they're
to-
both buzzwords.
Well, you couldn't do the cloud stuff without some form of cloud, but perhaps that's not what you mean. But the ability, what you're saying is the ability to innovate for small,
Yeah, that's right, yeah.
early stage companies,
Yeah.
and to then deploy
Makes it a lot
at scale.
cheaper.
Yeah. Did that answer? Was that what you're after? Any other questions? We've got a few minutes. Yes, sir.
Thank you. Hi. There's a lot of talk about frictionless banking, but yet we still have the cheque. I presume that's a generational thing. I mean, I haven't seen my chequebook for 20 years. I think I've got one somewhere, never used it. We've also got mobile banking, and presumably cash is going to go the same way. So are banks going to become split by demographics and no longer the one-stop shop that we used to?
Interesting. I was going to touch on cheques because I was trying to remember when there was first the announcement that cheques were going to disappear within the next year. They haven't. I still use a chequebook where I need multiple signatories because bank accounts can't cope with it, or institutions that I deal with can't cope with shared distributed approvals, a bit like my earlier point. So it's quite remarkable that we're still using cheques.
It's
Megan.
interesting, yeah. There's some legislation around banks being mandated next year to enable check imaging. So right now, you would have to go into a branch location to deposit one, but what's available is the ability from your mobile device to just take a picture of the check to deposit it. So that will be available next year. So I think even for those who are still using checks, there will be more frictionless ways, basically, of depositing those funds and accessing them. There's also, kind of just interestingly, when we launched Starling, we very much assumed that in the adoption curve, we'd very much have early adopters, kind of the digital natives, 18 to 35, working in a city, probably in tech, typically a bit more highly affluent. Typically, they're more male. And what we found is, one, it spans the age range. So we thought it was really interesting that we were seeing just as many people who are 60, 70 plus signing up and opening accounts, because we thought that there was going to be this large body of people who were either a bit more hesitant, they were afraid of mobile, or they didn't want to do all of their banking off of mobile. But we haven't seen that to be the case. And so what I think we found is that if you take something that's currently difficult or that you don't like doing and it's made really simple and easy, so you make it easy and you make it free and you make it very accessible, it doesn't really just slot into a particular demographic. It's kind of equally appealing across a number of different demographics. So, yeah.
So, James, do you think we're splitting by demographics? Is that a challenge? Do we just wait 20 years for all the old people to die and then it'll be a little easier?
Yeah, that's some political parties' problems at the moment as well, isn't it? Really, I think age isn't the only demographic. I think there's also affluence in there as well, and I think what you see is a widening gap between the extremes of having not very much money and paying for most things with cash and not being able to get on a London bus to paying with facial recognition through your phone or saying, Alexa, please pay for my conference ticket to TechFin. And I think that extreme is going to widen. And I think it's not just about age, but obviously age and affluence can also go together in terms of. But it's about social exclusion, and I think it's a big challenge. I think it's also kind of coming in rather more kind of. Insidious is too strong. Apologies, sorry, but when you're seeing adverts on telly for insurance brands who now have an app that help you improve your driving, you also know that that's going to essentially be assessing at some point the extent to which you were driving safely should an accident happen, which is protection for you, but also it's going to be monitoring people's kind of good behaviour, and premiums will inevitably be something that can be affected as a result of that. So in the relatively medium term, I can start to see a world where people who can afford certain insurance products, for example, or people being priced out of those insurance products through certain behaviour because of the extent to which they can be monitored. I'm not getting all kind of dystopian about it, but I think that it's just as part. It's not just about checks being a useful thing for old people. It's sort of slightly on a bigger scale of that, which is how do you design for all different types of preferences and capabilities when it comes to payment and financial transactions.
Well, I think, as I was going to say really quickly, that's why we're moving towards lots of small apps that do one thing really well. Like you might have Venmo, just to send money to your friend, or you set up Patreon just to crowdsource your income, not necessarily thinking about a whole suite of products.
Even more complexity. Anyone got one final punchy question to leave the panellists with? At the back. Is it about robots?
Hi everyone. So you mentioned earlier about Citigroup did a study that in 2025, like 800,000 people in the US will be taken out of the banking services industry because of fintechs. So my question is, how many people in the banking sector will be displaced through automation? So London employs about 1 million people in financial services. What percentage of that do you think will be taken out through robots and AI and stuff?
In the UK, hold fire. In the UK or globally?
Either. I'm curious about UK specifically, but that might be of interest.
Final point from each of you on that question. Phil.
I think it's a really dangerous thing to guess about how many people get put out of work by automation, because we've been talking about it for the last 50 years and it's never actually happened. What it does is it changes the kind of work people do. So I think that there'll be much more focus on creative uses, which is much harder to replace, and hopefully freeing more people up to do that kind of stuff and having more innovative kind of products as a result. It certainly put some of the manual labour out, but hopefully that moves it into a different area.
Yeah.
Megan.
From our perspective, with automation and AI, the state of the art and the state of the practice aren't the same yet. And so oftentimes what we see in terms of AI and automation is just using traditional engineering models or fancy decision trees, but it's not actually intelligence, is the way that you kind of think about it in the scary Elon Musk terms. So I think we're a bit far off from seeing significant displacement and seeing that come to fully to fruition. That being said, what we have seen previously with technology when new platforms are created is that it creates new opportunities. So Airbnb is, a hotel service that doesn't actually have any hotels or employ any people. They employ people, but not within these hotel chains, but they create new opportunities for people to rent out their own rooms. Or Uber, who doesn't technically employ a taxi service, but enables individuals to become their own drivers. So it creates different opportunities and new roles. I think when people think of AI and automation, there's almost a fear of the change and a fear of what's going to be lost, and so we tend to focus on that. But it doesn't necessarily lend itself to seeing the opportunities and the new roles that it creates around it. So I think that while we'll see displacement, we'll see a whole host of new opportunities that manifest alongside it to create new jobs as well.
I think automation is going to help people to do their work better, but I think rather than focus on jobs lost through future things like that, I think we should be more concerned about the banking jobs that are going to be lost via Brexit. One of the impact reports is supposed to be published today, I think, but I doubt that will happen. But that's probably much more of a threat than AI and automation.
James?
Yeah, a few of these things happen in isolation, I agree. And few of us are getting less busy just because we have better technology to help us. So I'm not qualified to talk about finance jobs out of being lost, but I do know that in some of the research that we've been looking at and talking to people about how they feel about this stuff, you talk to them about AI and you talk to them about not being serviced by people. Some of the people I've been trying to sort of be the voice of today do actually express a concern about the loss of jobs. They express a concern about the social impacts, about where these jobs may be going, which is another interesting factor to think about when communicating one's powerful machine learning capabilities to a different sort of customer, I think, perhaps.
Fantastic, thank you very much. There is a fantastic TEDx Bristol talk going online imminently, which covers this subject in a broader detail, which is I'd recommend you watch by Charles. So thank you, panel. Thank you, audience, for those questions. How would I sum up in the -2 minutes that I've got? I think what I'm hearing is there is plenty of opportunity to continue to innovate and make positive change. But there's a whole set of constraints, barriers, bumps in the road around trust, around risk, around loyalty, relationships of one form or another, frictionless or otherwise. So not surprisingly, it comes down to people in leadership and in the users of the technology. So what a surprise, it's all about people. Thank you very much. Please join me in thanking the panel.